Chapter 15, Part E. Ordinancy. So petitioner or any respondent can make application for a judicial sale at the ordinancy or the end of redemption period. He must satisfy the court that the value of the property is high enough to pay for the cost. If the amount due is not within the set time of redemption, the petitioner can apply to the court for an order absolute. This order declares the respondent are foreclosed of any right, title or interest in the property. So order absolute basically means we have nothing there anymore, right? Basically bank becomes the owner. If they sell for less, is there. If they sell for more, still is there. If the property value is worth less than the debt owed, because the petitioner can sue the borrower on his. If property value is 350, debt owed 375, so how much he still owes? $25,000. Sue borrower for $25,000 for the difference between the value of the property and what still owes. Why go for an order absolute? If the property value is equal or greater than the debt owed, because the petitioner then personal covenant for the difference owed cannot sue the borrower or his personal covenant. Property value 350, debt owed 325, profit 25,000. The petitioner doesn't have to doesn't have to give the money to the borrower for any profit made. So this is for order absolute. He doesn't have to pay. To keep the cash. Judicial sale. So the petitioner would ask for an order absolute, right?
Declaring our
respondent foreclosed on. Do you understand, right? So order absolute, the bank doesn't have to pay, right? Bank would want, what would the bank want? This one, right? If you owe more, you would want order. So being a borrower, you don't have to pay the difference. But for judicial sale, you have to pay. And quit claim deed. This mostly comes in. If the borrower is unable or does not wish to redeem the mortgage, the borrower may wish to quit claim. Quit claim his interest in the property to the lender.
Quit claim means like give up, right?
Yeah. If you owe $400,000, the value is $300,000, you say, okay, I'm gone. The borrower must receive some consideration for it. That's what happened in the USA, right? Nobody went down, walked out. When the quit claim is registered, it transfers title to the lender. So basically bank becomes the owner. It usually extinguishes the mortgage loan. So it will kill the mortgage loan basically. Basically you do give up.
Okay.
You know, you don't have a job, you don't have a...
No, but they cannot come for the balance.
No, just listen. Here we are only talking about quit claim. What do you mean by quit claim? Basically you quit your claim. Next is possession and sale. Allow the lender to take possession of the land either for its own use or for the purpose of renting it out. Basically in this one, if you don't pay, what the bank will take a possession. Will rent it, right? The lender will get a writ of possession or a writ of possession from the court if the borrower will not vacate. Next, agreement for sale. Unlike most mortgages, when you give a mortgage, you receive fee simple interest and have your name on the certificate of a title. Under an agreement for sale, the owner of the property you are purchasing agrees to sell the property to the purchaser. The purchaser agrees to pay the purchase price, usually a down payment, plus monthly payment of principal interest in exchange for the purchaser's promises. For example, I buy a property say for $550. I give $50,000 deposit. I say, okay, no problem, I'll complete after 2 years. So the guy had 5-year locked-in mortgage, right? So otherwise he has to pay a penalty. So I save and he also saves. So the title to the property stays in the original vendor's name until the purchaser has made the final payment and title is transferred at that time. So after 2 years, you pay the money, the title transfer, okay? The agreement for sale is registered on title as a charge highlighted as a charge, using a form C of the new land title firm. Yeah, so basically in this chapter, the quick one is very simple. The question they ask is number one, what is a mortgage? Mortgage is a security for a loan, is a contract, right? The evidence for a loan, okay? But it is not a loan. And then they ask you the question about equitable. What is equitable? Is basically
your equity.
Your equity is not registered, right? And then duplicate certificate title. When do we get it? If you title it,
mortgage.
if your property is a mortgage free, clear title, then you get the duplicate title. Okay?
Use it for other collateral.
Yeah. And then we talk about what do we call a lender? Mortgagee, mortgager, borrower, right? And acceleration clause. If you don't pay the payment, 1 month, 2 months, 3 months, the bank will ask you to pay now 100%. Whatever the outstanding balance. For example, $500,000. And how many bucks? Basically, bank would give you a little bit of more mortgage
money
added to pay your property taxes, to your 2-3 payments behind. So that's omnibus. And then we talk about insurance. So you need to have insurance, home insurance, right? So that the bank can be, bank mortgage can be secured. And then you have to maintain your property. Right? And if you are a guarantor, so basically you are also liable. Then portability means you can take your mortgage along with you. Then we talk about blanket coverage. Blanket basically means it covers the project like a higher project until you sell it to the individual. And then we talk about vendor take back. So where vendor give you the mortgage. Then wrap around usually is a lower rate than the primary rate, but is not common anymore. Reverse annuity, basically you take the mortgage against your own equity. Then federal interest rate, basically up to 60% you can charge, not more than 60. And if you don't mention, then no interest can be charged. If document doesn't mention, but if document mention or you forget to tell the rate, then 5%. Okay? And then they charge annually or semi-annually, blended payment. And then we talk about the Consumer Protection Act. It covers only individual, not corporations. It covers only up to $150,000. And then we talk about mortgage broker, some mortgage broker. Some mortgage broker basically work under a company. Okay? And mortgage broker, you have to sell minimum 10 mortgages. That assignment of a mortgage you can assign, but then you are liable to pay still. That assumption you can assume the mortgage. Then the New Property Law Act, where the lender can go against the second borrower too. And then we talk about the foreclosure. First one is the petition, right? So basically you have to pay. And then the order is the first order of the court. Okay? And then judicial sale. Judicial sale basically, if you owe more, the bank can sue you for difference. Then order absolute. Order absolute basically means bank becomes the owner. If you owe more, they can't offer you. But if they sell for more, they keep the money. Right? Then quit claim. Quit claim means you owe more than your mortgage. So basically you quit your claim, bank becomes the owner. And then possession and sale. Basically bank can take the property and can rent to somebody. Okay? The agreement for sale basically means you make an agreement and you pay the payments and the title is still under the original owner's name. After 2 years or whatever time you think, then you transfer the title. So that's the agreement for sale. That's it.